friends, welcome to Yadnya Investment Academy. In this journey of wealth creation through mutual funds, there are certain mistakes that we tend to do. The intention of this video is to make you aware of such mistakes so that you can avoid these. The first mistake is considering mutual funds with low NAVs for investment. Now, investing in case of stocks and in case of mutual funds is different. In case of stocks, you're investing into the intrinsic growth potential of a company. So the sooner you buy this stock, there are more chances of you making profits. In case of mutual funds, you're not investing into the intrinsic growth potential of a company, but a collection of stocks. And this collection of stocks could change the next day depending upon market conditions, view of the fund manager, etc. So in case of mutual funds, your returns are based upon the difference between investment and redemption NAV and doesn't depend upon the level of NAV at which you have invested. Generally, new mutual funds or NFOs would have lower NAVs. Now, these mutual funds do not have proven track record for you to invest into them with confidence. In that comparison, it would be a better idea to invest into seasoned mutual funds available in the market with proven track records which help you to invest into them with confidence. We have a detailed video on this particular point which explains whether you should go for a NFO or no. If you need more information about this, please watch this video. Another mistake that we do is we invest lower amounts. Now, we get numerous comments saying that we already have SIPs or we have started SIPs where we invest 1000 rupees each month into A mutual fund, another 1000 rupees into B mutual fund. Now, you may have never invested into mutual funds before, and just to check stock market waters, you have invested a low amount. But after some time, you experience that you are actually getting handsome returns. But the mistake happens here where you never increase your contribution. So here, even after getting good returns from your mutual funds, your overall return would come down as the major chunk of your investments are into low yield options. And so, if you feel that the waters are safe, just take that plunge. Don't hold yourself back. Increase your contributions in line with your financial goals. We have a detailed video on this particular point, and if you need more information about it, please watch this video. Another mistake that we do is we invest a lump sum amount in ELSS in the last quarter of the year. Now, data suggests that around 50% of ELSS investments happen in the last quarter of the year, and around 22 to 25% of investments happen in the last month of the financial year, that is in March. Now, when you do this lump sum investment, you are here losing the rupee cost averaging benefit offered by SIP. This concept of how you get an average purchase price when you're investing systematically throughout the year has been explained in detail in one of our videos, that is benefits of SIP. If you need more information about this point, please watch that video. Another risk involved here could be of market timing. What if the market is at all-time high when you're doing this lump sum ELSS investment? But just because you have to save your tax, you'd go ahead and invest into the market when it is already overvalued. So hope this year you would avoid this mistake and invest systematically even for your tax saving needs. Another mistake is doing a lump sum investment in equity when the market PE is above 25. Now, the PE ratio of general indices like Sensex and Nifty give you an overall sense of the market. These tell you whether the market is overvalued or no. So if the market is overvalued and you do a lump sum investment, you are hardly going to earn any returns and you might even have losses. So if the Nifty is above 25, remember here we are talking particularly about Nifty and not other indices. So if Nifty is above 25, a better strategy would be to invest your lump sum amount into liquid funds and from there do an STP in equity funds. We have a detailed video explaining this point as shown here. If you need more information about it, please watch this video. Another mistake is not investing for the right investment duration. We are generally scared of the stock market. Now, anywhere the main reason of fear is lack of knowledge. And so, this logic stands true for everything in life and not just mutual funds or stock markets. So if you are aware of what investment vehicle is suited for what kind of a time horizon, you would be confident enough to invest into that kind of a mutual fund. For example, up to 3 years of investment, debt funds are a good choice. For 3 to 5 years, balanced funds are good. For 5 to 7 years, you should go for large cap funds. For 7 to 10 years, multi cap funds is a good investment vehicle. For 10 plus years, you should go for small and mid cap funds. And in case of ELSS, you should not only stay invested for 3 years of lock-in period, but you should stay invested into these funds for 5 to 7 years, as ELSS are equity funds. So you must have experienced or seen that whenever you're not matching the investment duration with the right kind of fund, you might be making losses and you might be making wrong opinions about mutual funds. So choose a fund and invest for the correct duration and you would definitely have good returns. Another mistake is investing based upon last year's performance. Now, when you match your financial goal with the right kind of mutual fund type, look at the historical data too based upon this horizon again. For example, in case of mid-cap funds, which are good for an investment duration of 10 plus years, look at the historical data of various funds for last 10 years. And pick a fund which has been consistent in the past 10 years. In case of liquid funds, which are ideal for an investment duration of 3 months, most of the funds give similar returns. And so here you should go for a fund which comes from a big fund house and has a lower expense ratio. So this is how you should be logical when you look at historical data too. We have a video which tells you how last year's performance of a certain fund which has been outstanding may not be a good choice for you to invest into it if the fund has not been consistent. If you want to see that video, please go for it. Another mistake is over-diversification. Now we get a lot of emails with a huge list of the funds selected asking our opinion over the selection. Now a maximum of 2 funds per goal should be a good amount of diversification. Over-diversification makes it very difficult for you to analyze your returns. Another mistake is not matching your own risk profile with the kind of fund within a category. Now, within various mutual fund categories, there could be conservative funds, aggressive, growth-oriented, etc. type of funds. For example, in case of ELSS category, Franklin India Tax Shield Fund is more suitable for conservative investors. Access Long-Term Equity Fund is more suitable to growth-oriented investors. Aditya Birla Sun Life Tax Relief 96 Fund is suitable for aggressive investors, while IDFC Tax Advantage Fund is more suitable to very aggressive investors. Let's say, for example, you're not an aggressive investor, but based upon the kind of inflows you had to choose an aggressive category like mid-cap funds to reach your financial goal. So in that particular category, you could go for a fund that suits your own risk profile. Another mistake is buying a dividend option when you actually don't need it. Now in your working years, you already have a source of income. So these dividends are something you hardly depend on. But you buy it because you think it could be an additional source of income along with the primary source of income you have. But these dividends take away the compounding effect from your investments. Moreover, the amount of dividend declared is minimal, which could hardly serve as an additional source of income. For example, the dividend amount declared could be just 0.6 rupees per unit in a year. Now you might think that this is a minimal amount and it could hardly have any impact on the compounding effect. But you're again forgetting that these returns would again earn returns, and that is what exactly is the compounding effect. So friends, those were the 9 mistakes put together. There could be some additional ones which we would make you aware of through our various videos. But hope now you would avoid all of these when you invest into mutual funds. Thanks for watching this video. Watch this space for more such topics. If you have any questions, do let us know in the comment section below our videos. And if you like our videos, please do subscribe and share. Friends, if you're trying to search certain videos on our channel, we request you to add by Yadnya to your search string so that all the videos related to your search string that are available on our channel would be listed first. And now before we end, we want to let you know that Yadnya Investment Academy's first book, which is a collection of 108 questions and answers on mutual funds and SIP, is available on Amazon, Flipkart, etc. And the link to buy the same is mentioned in the description of this video. So see you in another video. Until then, happy investing.